Hello and welcome back to this course on commodity spread trading and the theory behind it. Looking back at the last video, we began to cover the topic of money management. We talked about the importance of risk management and the need to have a clear strategy in order to better manage our money and also help keep control of our emotions. As we saw, having a clear strategy and plan is fundamental in being able to manage your money. It helps not just protecting your capital invested, but can also go a long way to helping you control the emotions that are attached to being a trader. In this video, we're going to expand on the creation of the strategy, looking further at stop loss and take profit, and how we can effectively manage our positions. So let's cover the first one of these. Okay, so things aren't always as good as they first appear. Imagine that this is the situation. You have done your research, you've identified potential trades from the databases and other information available, and then you've refined the data and confirmed what looks to be a good trade to make. As we said in the first video on money management, it's important to have a plan should things not go the way we hope they do. We need to protect the capital we will be investing in the trades as much as possible. To do this, we need to know when to accept the trade is not going to be a profitable one and close it to prevent losing all our capital. Remember the 5% rule. We never put 5% of our capital into a single trade. And therefore, when looking at a stop loss, that's an order that closes the trade and therefore blocks any further losses, we should apply the same rule to the amount invested. Let's look quickly at potential loss and recovery. We know well, some of us from personal experience or by the experience of others, that if you lose half your capital, you'll have to double what's left to get back to the position you started with. Your capital can be reduced very quickly, especially without an adequate strategy or plan in place to protect it. It's much harder and takes longer to recover what's been lost. In the table on this slide, in the left-hand column, we show the levels of percentage loss. The column on the right shows the performance growth that will be needed on the residual capital to return to the amount of the original investment. As you can see, the more you lose, the higher the performance and percentage increase required to replenish what you started with. We've already said 5% should be the maximum loss on each single trade. This doesn't mean, however, that I always have to take risks and enforce the 5% rule. If total earnings from all of my trades remain in line with the expected overall performance, that is, that I'm making more money on my positive trades than I am on those that are not performing so well, I can close the losing trades out before they reach the 5% level. We have identified 5% because mathematically it allows us not to get into trouble. It's a level at which we should be able to recover our losses. But I only ever apply a maximum 5% loss in two specific cases. The first of these is a sudden or an unexpected event, something that could not be predicted that has an impact on the market. The second is when, having analysed the situation, redone my fundamental and technical analysis and identified an entry point I can close off the losing trade with a 5% loss and reopen the position in order to gain a benefit from either the reversal in the market that caused the loss in the first place or the continued movement in the direction that went against me. These are the only two instances that will cause me to lose the maximum of 5% per trade. There are also other factors we need to take into consideration in respect to our trades. We also need to look at the margin when considering the stop loss level. Margin is a unit of measurement produced by the exchanges that takes into account the risk of the instrument at the given time. Also, when considering placing a stop, you must know and understand that its positioning is not unique to all spreads. Different futures for different commodities all have different weighting, margin and volatility. So now a question. When selecting a trade, if one half of it has a margin of more than 5% of my capital, what should I do? The answer should be simple. Don't do the trade. This point is fundamental. I cannot recommend the do not trade message strongly enough. Regardless of how good a trade potentially looks, we should never make trades that we cannot afford. Developing a strategy, making the rules and limits and sticking to them is vital for survival and the long-term ability to get consistent profits. There is a need to estimate the volatility of a spread when trying to figure out where to put a stop loss. Volatility is simply the measure of the change in price of a financial instrument over time, and we've already seen in an earlier video how we can identify this for commodities. The more volatile an instrument is with rapidly changing prices, the more difficult it is to control and manage a position that involves it. In spread trading, intramarket prices tend to vary less rapidly and therefore have a lower volatility when compared to an intermarket spread where volatility is likely to be higher. This table shows us which of the commodities we use for intramarket spread trading are the most volatile. As you can see, the soft commodities like soya and grain tend in general, now remember there can always be an exception to the rule, to have lower volatility compared to that of the other raw materials, whilst the higher value hard commodities such as precious metals and energy display greater volatility. The statistical sites also provide us with help regarding volatility by showing highs and lows of spread deals over the past years. In this table we can see some historical data relating to an intramarket spread in lean hogs, where the database has identified a potential spread of buying February 16 futures and selling the December 15 futures. Note the dates recommended for the trade on the second row of the table, as these are important to remember. Entry on approximately the 30th of July and exit on approximately the 1st of November. This time period is known as the seasonality window. So what does this table show us? Firstly, this is the historical data for the same trade for the last 15 years, covering 2001 to 2015. If we take 2015 as an example, we can see the entry date that the trade was made and the exit date for the trade. Note, they're very close to those advised as the seasonality window at the top of the table. Next, we see the amount of profit the traders made at the time the position was closed. The best equity date shows the date the spread was at its highest price during the seasonality window. In this example, this also happens to be the date that the trade was closed. The best equity amount is the theoretical profit that would have been made if the spread had been closed at the highest price in the seasonality window, which in this example is what happened. But if you look at other years, you will see difference between profit made and best equity figures, indicating volatility in the spread price during the seasonality window. It didn't follow one particular trend. The column showing worst equity date shows the date on which the lowest price for the spread was seen during the seasonality window. The final column in yellow, worst equity amount, shows how much loss theoretically would have been made if you'd closed a deal at the lowest price. Other information that's shown in this table relates to the number of years that this has been a profitable spread trade to make. This is shown by the number in the winner's cell. In this example, 15 dictates that the trade has been profitable for every year for the last 15 years. What it also shows is the figure for a protective stop. This is a suggested value, in this case minus $1,127, that you could set as the maximum loss you would be prepared to take on the spread. You could use this value to calculate your stop loss price using the tick value of the future. A little reminder here. Firstly, this is historical information from the database and only a suggestion of a possible trade. When we looked at fundamental analysis, we discussed only using this as an indicator. Never trade on the back of just this information. Make sure that you confirm the viability of the deal by conducting technical analysis as well. Secondly, although this is suggesting a maximum loss, check what percentage of your capital this relates to. If it's over 5%, then you have two choices. Set your stop so the maximum loss is within 5% of your capital, or do not do the trade. When setting your stop loss, consider the volatility of the spread. Looking at all the years in the table, there are a number of them where the best equity amount is higher than the actual profit made. Taking 2013 as an example, we can see that the best equity amount would have been $920 if the trade had been exited on the 30th of August. The profit made on the 1st of November when the trade was closed was $188. The lowest price, where a loss of $152 would have been made, was the 8th of October. From this, we can tell that the price increased after the deal was placed. It then suffered a reversal to below the deal price before recovering to allow the deal to be closed off at a profit. You'll need to check the current spread price volatility and factor that into where you set your stop loss. If it's too close to the price traded and the market is volatile, there's a high chance the stop price will be reached and you'll have made a losing trade. Putting the price a long way from your entry price may mean that it's not likely to be reached, but if it is, that could mean your loss is over your 5% limit as per your strategy. If the market is volatile and you're not sure, don't trade. Looking at the next slide, this shows the example of a trend, the black line, in a current spread, as well as a trend of the spread over the last 5 and 10 years, the red and green lines. Overlaid into this is the suggested range for the spread movement shown by the dotted red vertical line. As the graph suggests, the price is volatile with a good deal of fluctuation over the last 4 months. Again, as with the previous example on historical data, careful thought is needed where to put your stop loss at. If you put it in as a $100 loss, there's a good chance the price will be reached due to the fluctuations and the volatility. Widening the price from where you traded it and putting it at 1,000 would reduce this risk, but it would still have to be within the 5% capital that's part of your trading plan. Okay, now let's turn to a happier subject, profit and when to take it, i.e. closing a trade to take the profit it has made. As part of a trading plan, we need to look at the ratio between how much loss we want to make compared to how much profit we want to earn. At minimum, the ratio should be 1 to 1. That's to say we're prepared to lose $500, but at the same time we'd be happy to make $500. Ideally, you want to make this ratio as high as possible, but keep it within the realms of possibility. So a ratio of 1 to 2, i.e. $500 loss against a $1,000 profit would be better. You can incorporate the ratio into your strategy for the deal. By knowing how much you want to profit will help you determine where to place your take profit, which will be the price at which you close the deal. Something that we can do when our available capital allows us to, still keeping within the 5% rule, is to trade a spread with more than one futures contract. In the example shown in the chart, we open a position with 2 contracts, buy and sell 2 futures to create the spread at the price indicated by the horizontal white line. We set our stop loss, the horizontal red line. Now note, this will never be moved lower as it's a target identified in the strategy of the trade, but it could be moved higher if conditions allow, and I'll explain this shortly. Looking at the gains we could make, what we look to do is set 2 different levels on where we can close the trade should it move in our favour. The first take profit, the lower green line, is what was identified in the analysis as showing the strongest signals of where the price could potentially move to. We can close the first part of the spread at this level by selling and buying 1 futures contract, and then if the price is moving favourably, allow the second contract to run until it reaches the second take profit level, the higher of the 2 green lines. This level would also have been identified from our analysis, but without such strong indicators. With this type of strategy, we can look to improve the overall performance of the trade from the indications originally confirmed in the analysis undertaken before it was placed. The rules for this type of position management are, firstly and most importantly, never move the stop loss to a lower level than the target in our initial plan, but instead move it upward if the trend of the spread moves in our favour. Firstly, trying to place it in a position of break-even as soon as possible. This would be the white line indicating the entry point of the trade, and then possibly higher if the price is moving in the right direction, so even if the stop loss is reached, the deal closes in a profit. We've wandered down the theoretical path of money management together. I can only give you the guidelines with regards to creating a strategy, having a plan as robust as possible that helps limit the emotional states the market can produce. We also need to understand that the application of certain notions and money management rules may change depending on market conditions that we face at any given moment. We have, across the 2 videos in this section on money management, covered off risk management, stop loss, position sizing, capital risk, and position management. In the next and final session of this course, we will start to look at the operating factors of spread trading and how to build out your experience. I'll speak to you later. Speak soon. Bye for now.